You better be careful, everybody. Your IUL is going to lapse. What's up? Welcome back to our channel here at the Banking Bros at the Cash Compound. I'm JDew, and what we want to look at is an IUL indexed universal life illustration that someone sent to us asking us for a little bit of a policy review before or just in case they wanted to get started with this idea of IUL. Now, true or false, let us know. The reason that you've been excited about this IUL illustration and what people have told you out there is because you've heard of upside potential and downside protection. Here's my question for you. The three things that are so important to you in an IUL, let's go over them in this illustration review right now. Number one, guarantees. Number two, growth. Number three, tax-free liquidity. As you can see in an IUL illustration, the most important thing you want to take a look at are the illustrated values inside your illustration. Every single IUL illustration, as well as other policy illustrations, give you the numbers in which the insurance company is guaranteeing you, and also some alternative numbers that they don't actually guarantee, but they think might, could, shoulda, woulda, maybe happen for you one day. So this particular client and customer looked at this particular illustration and said, I'm thinking about putting it on my daughter. You can see the ages there in the leftmost columns. And they looked at $350 in premium per month, $4,200 per year. Yes or yes? So you can see in the leftmost columns, you see what they're going to do guaranteed, what their premium outlay would be. In our version of explaining what we do, we'd say that's cup number one, right here. So they decided they were going to take money out of their pockets and put it inside the insurance company's contract for them at $350 per month or $4,200 per year. That's cup number one. Now, of course, at the outset of any type of life insurance contract, there's going to be a death benefit. And as we take a look over here, moving way over, you can see that $748,000+ is the guaranteed death benefit over on the other side. So what you can see here is in cup number three, I've put in our $748,000 that will be payable upon death to our beneficiary. Of course, these dollars are going to pay out if and when this contract is still in force when the insured body actually passes away. We hope that's a long time away, but also in this particular IUL, you can see that option B has been chosen, which means there will be a growing death benefit throughout the insured's life. Now, here are my questions. Why in the world would you want a contract like this? Once again, we've talked about guarantees, growth, and tax-free liquidity. The reason that I and you have heard why IULs are so powerful and so great is because every dollar that you put in is going to have the upside potential of the market up to a certain point and downside protection should your indexed values dip below the baseline of 0. So you can't lose money. You'd hold what you've made so far. Yes or yes? Once again, if this is what you've heard, we'd love for you to throw it down in the chat or ask us questions and have comments ready for us. But we're looking at the actual contract illustration from this particular company, which is one of the top companies that is selling IULs today. You can see that in our middle columns in the green section that we have a weighted average interest rate of 3%. We're going to focus on that for just a few minutes. Remember, if your indexed strategy earns you 3%, then these are the numbers that you can expect throughout the course of the growth of your contract. I want to point at them for just a few minutes to help you understand a few things, and we're actually going to read the contract and look at some of the fine print. But the numbers look great, right? And everything is rising 3% year and year and year and year over and over again. So many people are using the IUL strategy as an alternative for their retirement income to supplement what they want to have when they no longer are working for dollars. So let's dive down a few years and let's take a look and see what happens in that block between policy years 66 and 70. That's where it starts to get interesting. And I just want to help you understand in this video, there's more to come about what's going on at this point. Remember, we've never taken any losses in this illustration at this point. And in our middle column, we've got 3% growth each and every year on what has been happening. That's been credited to us inside our cash value accounts. So we've got a whole bunch of money there at this point. Let's take a look. You can see that in the 67th year, when the age of the insured is 66, this person decides they're going to start taking planned annual income of $318,000. Now that sounds like plenty of money. Who knows, therefore, into the future, but you can see that we should have enough money to be able to take home. And over the course of 1, 2, 3, 4 years, you can see that she has been able to take out $1.275 million at this point. You can see that's what's going on. But let's see what happens to our illustrated values in our centermost columns. See, what happens in year 67 of the policy, when she is 66 years old, is that we're starting to drain our cash surrender value. That's right here in the green cup, cup number 2. Let's look back again. You can see that in the year 69 of the policy, 68 years old for our insured, we see in that middle column the word lapse. That's what I want to focus on right here. Why in the world did this lapse? Isn't this supposed to be here and be permanent? Ladies and gentlemen, once the policy lapses, there's no more death benefit. It's gone. It's over. Now, IULs come under the big umbrella of permanent insurance, but I have a question. What does permanent mean to you? Now, over the course of this amount of time, you can see that the family has contributed $277,000 into this policy contract. They've been able to take out, according to these illustrated values in the middle column, $1.275 million, but now the policy is gone. It has lapsed and it is no longer available. Let's take a look at some of the fine print that you see underneath some of these values on each page of this illustration. It reads, benefits and values are not guaranteed. The assumptions on which they are based are subject to change by the insurer. Not the insured, not the family, not the owner of the policy, but the insurer has the ability to change them. Interesting. But then look at this crazy list and how many things there are. The rates for the percent of premium expense charge, monthly cost of insurance, monthly expense charge, monthly policy fee, monthly percent of accumulated value charge, rider charge, and withdrawal fee are, if any, not guaranteed, will be determined by the company and may change from time to time based on expectations of future anticipated or emerging experience. That's a lot of risk that we, as an insured or owner of the policy, do not control and do not hold. The insurer, the company, has the right to change all of those expenses. So if any of those charges do change over the course of 66, 7, 8 years, you do realize that the values in those columns are going to be completely different. Now, we're not even talking about the third most column of values. We're only talking about 3%. Now, I think most of us have been told things like maybe 8, 9, 10, 11, 12% potential growth with that upside potential. But this is showing 3, and we still have a policy lapsing over the course of our lifetime. Now, I assume that this family wants their daughter to live much beyond 68, 69 years old, and I think most of us probably could and should, with regular type of mortality, morbidity, and heck, personal life choices. But at this point, this policy is actually gone. Let's keep reading. The policy as shown, using the alternative current illustrated values, will lapse in policy year 69. This is based on the alternative current interest rates credited and current charges. Take a look at that. So if the charges change and they become more expensive and they go up, this has the ability to lapse faster. Now, of course, it's hard to illustrate what this family or this insured person one day might actually do with the policy numbers. I just want you guys to realize that they're telling you it's guaranteed to lapse at these current showings and illustrations. These changes may include, but are not limited to, the increase, reduction, or elimination of the listed rates and amounts after a certain number of policy years. Now, come on, do you think that these charges are going down or they might go up over time in favor for the insurance company? It's up to you to decide. I don't tell the future, but I think they might be going up. Future anticipated or emerging experience can include, but is not limited to, investment earnings, mortality, persistency, taxes, and expenses, which may affect these assumptions. Actual results may be more or less favorable. There you go. There is a charge for cost of insurance and other expenses in years when no premium is paid into the policy. So even in the event that this policy continues because the values are better than 3% credited and growing throughout your lifetime or this person's lifetime, there are still charges. Remember that even though you are not putting in more premium. So there are still charges in this policy, and those charges will wear down what that potential accumulation or growth is doing. You need to understand that to properly identify what is the potential in your IUL contract. Premium payments, which may be greater than the initial premium, may have to be resumed to maintain the policy in force. So remember, ladies and gentlemen, if you want to go down the route of an IUL, you need to understand that the charges inside this policy and the performance of the indices that the insurance company does not control, but they do control how they participate and how much they charge you to participate and what they credit you, is very, very important. And I ask you again, the reasons that you got into a contract like this probably were for the three things I said earlier. Let me review. Guarantees, growth, and tax-free liquidity. The point of you getting into this, I thought, was so you for sure had a larger amount of money to be able to utilize in your retirement years. But do you? How do you know for sure? We'd love to hear back from you if you have chosen IUL as the way for you, and if that isn't exactly what you were thinking when you saw or heard the wonders of IUL preached to you. We'd love to chat with you about cracking the code to Cashflow with guarantees, no risk, and tax-free liquidity in a different style of contract that can help you do it each and every time, guaranteed.